So in today's video, I'll be discussing the Airbnb stock, which is going to be freshly added onto people's trading platforms as from today, the 10th of December. So I'll be giving my thoughts on the stock, a bit of information about them, and also a bit of an insight into hopefully what the future holds for Airbnb. But if you're new to the channel, definitely consider subscribing on the goal to get to 2,000 subs. And also, if you really want to help me out, consider smashing a like on the video as well. It really does boost the channel out loads. And also fancy leaving a comment as well, let me know your thoughts on the video and Airbnb as a whole. So just a bit of basic information about Airbnb now. They operate a platform for stays and experiences to guests worldwide. The company's marketplace model connects hosts and guests online through mobile devices to book spaces and experiences. They primarily offer private rooms and luxury villas. The company, who was formerly known as Airbed and Breakfast, changed the name to Airbnb back in November 2010. It was originally founded in 2007 and the headquarters is currently in San Francisco, California. So a bit more of an insight into what Airbnb actually do now. Obviously, they're a marketplace where you can rent out rooms and properties to guests. Airbnb currently take a 3% commission off every booking from a host and between 6 and 10% from the guest. You can see a nice little graph of, hopefully it's an easy graph to follow, of the business model. Basically, it's a win-win for the Airbnb company overall. So obviously, hosts do get obviously some amount of the money, but Airbnb do take quite a nice little cut as well. We'll just take a quick look at the earnings and revenue history, which is usually my most important metric to look at when investing in a company. Warren Buffett usually said, if a company is profitable, then it's good to invest in. And as you can see, currently they are not actually too profitable at the moment. As of September 2020, they boasted a 3.62 billion revenue, but as you can see, did not keep any of that in earnings due to massive amounts of debt that they've accrued over the last year or so. Obviously, with what's gone on with the pandemic in this last year, they have been hit quite hard. So it's a minus 28.9% profit margin. But as you can see, with the forecast of the growth in the future of their earnings and revenue, it does look a little bit better. Again, this is all analysts predict, so you can't look too much into it, but you can see the earnings will dip even more, but by the time we get into 2023, they will be starting to retain a little bit more of that revenue, which will increase to 7.9, just under 8 billion in revenue. So you can hopefully people will start going out more, traveling around more, obviously finding more places to stay, etc. So that does look a little bit more healthy than what it does currently. So the forecast to become profitable in the next 3 years, which is considered faster than the savings rate. So basically the earnings, they will become more profitable, keep more of the money, which is faster than what they would get from lending a bond to pay for expenses, etc. The forecast to become more profitable, considered above the market growth. Again, so all these green ticks, it's all good news for the forecast. The revenue of 25% per year is forecast to go faster than the US market average, which is 10.4%, and the revenue again is forecast to grow faster than 20% per year. So it is looking a little bit better for them in the future, guys. The share price versus the value, so they're going to be trading at $58. So as you can see, my prediction is when the market opens on today, Thursday, well, whenever you're watching this, I'm not too sure what day it will be at the time, but I could be wrong, so comment if I'm actually wrong and it doesn't happen. But I do predict they will get to that round about that $117 mark, or maybe even more than that. It might become overvalued. So, but at the moment they'll be trading at $58. So the debt to equity history and analysis. So as you can see, the debt is rising. So it's got 1.83.9 billion in debt. So it's pretty much exactly the same as the debt, as the assets minus the liabilities. So it's around about even, a 99.1% ratio, which is considered high, by the way. So the cash runway analysis basically is for companies who have been on average making a loss in the past. They assess well whether they have at least a year's worth of cash runway, which basically means how long can they continue to last with while they're in debt or making losses. So they have enough cash flow to last for more than 3 years, which is good. So, but as you can see, Simply Wall Street doesn't have enough data to determine whether they have enough cash runway to continue to grow or shrink based on historical rates. So that's my thoughts on Airbnb, guys. It's just a quick video. There's not enough information I can find currently at the moment, but when I usually do these type of videos, I usually look a lot more into the past performance and then also return on assets, etc. But there's just not enough information. But I just wanted to try and get this video done as a time video really. I'm sort of a bit rushed, but I hope I've gotten a few key points in there, into an insight of how they're going to be doing, and a bit about what the company does also. So with that, guys, if you like the video, definitely consider liking it. Also subscribe to the channel as well. So I'm going to leave you to it today, guys. Take care. Bye.